You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts Alex the Viceroy Jacobson from Options Express, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody, that rocking tune means it is time once again for the Option Block, everyone's favorite bi-weekly source for all things options related. A little bit of wit, a little bit of wisdom, a little bit of analysis, a little bit of edumacation, sprinkle on some unusual options activity, and you have this program that we call the Option Block. My name is Mark Longo from the mothership, theoptionsinsider.com, as well as this ever-expanding, ever-exciting thing we like to call the old OIRN for short, the Options Insider Radio Network. 13 programs for you guys to choose from now on said network, and we're working on more all the time for you. So if there's a product category or a segment or some classification of options or derivatives that we're not touching on yet that you think we should, let us know. Chances are we're probably already working on it, but if we're not, hey, maybe you give us a great idea for a new program. We're always looking for those. And of course, you can find this content, well, anywhere. You can find it on the mothership. You can find it iTunes, Stitcher, AHA Mobile, as well as our mobile app available for iOS, Android, and the Fire OS. And if you haven't checked out the mothership lately, listeners, I encourage you to do so. We're making tweaks and changes to that all the time. So I know a lot of you guys like to tune in while you're commuting and listen to the shows, but hey, take a chance, surf on over to the old website. I think you're going to like what you find. And of course, this week announces the return of the much beloved and much bemoaned Options Insider email newsletter. We put it on a hiatus toward the end of last year because it was just getting too unwieldy. Too many people wanted too many different things out of it. The list was large, but that included advisors and asset managers and retail guys and you name it. They were all subscribing to that newsletter. So we thought, let's break it down, take it apart, and let's do letters and newsletters for the individual segments. So we're going to start working on those. And the first one of those, our retail-oriented trader newsletter, is going to come out this week. So stay tuned for that. If you're not a subscriber, surf on over to the website and sign up for that. I think you're going to like it. All right, a lot of cool stuff cooking over at the mothership. A lot of cool stuff cooking on today's show as well. And joining me for the old program, beaming in from the great state, nay kingdom, known as Maine, none other than the Rock Lobster himself, Mr. Andrew Giovinazzi. Mr. Andrew, welcome back to the show, sir.
Great to be back here. Well, true to my Maineness, I actually pulled my rusty, actually it's not a rusty, but old wooden boat out of the water and scraped barnacles on it on yesterday.
Isn't that on the license they give you when you go to Maine? They give you a scraping barnacles license plate because that's pretty much the state hobby.
Yes, that is. It is a necessary thing. Let's just put it that way.
Is that the state motto?
My vote will be much faster come springtime.
Is that the state motto? Come scrape your barnacles. Move to Maine.
Yes. Move to Maine. Live the good life. Actually, what do they call it? Vacation land.
That's awesome. I can honestly say I've never scraped a barnacle in my life. And that's saying something. I grew up in southern New England, so quite a few Yankees around my area, and all sorts of nautical tradition. Yet I've never scraped a barnacle. I've made it this far.
When you live in New England, some people actually are barnacles. It's hard to tell from the real thing.
That's true. There are a few of those. Speaking of barnacles, we will be joined in a little bit, listeners, by Uncle Mike Tusaw. A pretty high BBI day, as you might imagine, for him. So I think without further ado, let's get right to it. Let's dive right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. This is indeed, as the name implies, the portion of the program where we break down what was moving, what was going on, what caught our eye in today's markets. And it hasn't been a heck of a lot going on this week, Andrew. Pretty quiet, so I think you and I can just take the rest of the show off, right? Not much to really talk about today.
Yeah, I think it's time for a beverage.
Yes, a nice, tasty beverage. No, listeners, we are indeed recording this on Thursday, October 9th. And if you don't know, it's been just a heck of a day, indeed a heck of a week. We're coming off the heels of Wednesday, the 8th, being, of course, the biggest up day in the market so far this year, well north of 1% in most of the major indexes. And today, just like clockwork, we gave it all back and then some. Most of the major indices closing down nearly 2% in some cases. S&P closing today down 1.9%. That's pretty much at or around the lows of the day. And looking here at the Qs, we also saw the Qs off 1.4%. The Dow, the middle child there, down 1.8%. And surprise, surprise, VIX Cash launching skyward, up 3.71 handles to 18.82. There is so much to parse in these last 2 days, Andrew. I honestly don't even know where to begin. Volume is just off the charts. Of course, the rally yesterday, most people think was sparked. I'm not into the narratives, but most people think it seemed to be sparked by the salient comments coming out of the Fed that, hey, things are good. And of course, today a Fed governor threw cold water all over that and said, you guys, you traders are crazy. You're trading off some sort of dream fairyland version of the market. What's really cooking over here at the Fed is a lot darker than you might think. And that spooked a whole hell of a lot of people today, apparently, because as all the resulting turmoil ensued, we saw some serious action. Let's just look at some numbers really quick. VIX today doing just a hair shy of 1 million. I'm surprised. I thought that was actually going to break the 1 million level. It's been averaging 571,000 contracts a day of late, listeners. So you're talking nearly 2x day here from a VIX perspective. Looking over at SPX, remember, this is the big, meaty, man-sized contract doing almost 1.1 million contracts today, 1.077 million contracts. And that's been averaging 870,000 of late. So only a 200,000 contract bump there, but that still is pretty sizable when you're talking SPX. And then talking our ETF friends here, looking at SPY. SPY, just remember, smaller contract, but still, this is just lighting it up. SPY's been averaging about 2.2 million contracts a day, which is fairly robust, I think, by any contract standards. Doing 4.7 million contracts today. Just madhouse palooza times. Crazy numbers. I don't even know really how to process numbers like that, Andrew. It's pretty crazy.
Well, mostly I think that, just from a flat out point of view, I just saw a good stat because, this is a show. We love the stats that the average true range for the last 3 days or 4 days is the highest it's been in 3 years. So, I think, for myself, that's kind of significant, right? From old, marketing on the floor, volatility begets volatility to a certain degree. And we're certainly seeing some of that. So, and the volume is, I think the volume is showing that. I think there might have been a lot of, trying to, looking for the next bounce. And all of a sudden everybody's like, wait a minute, where's my, because we actually pre-market on the good jobs number, we opened higher. So the Fed releases minutes one day and then a Fed governor comes out and says something the next. I don't know. I wish they'd get their story straight. But I think there's a definite tug of war in the Fed right now.
I think that's what spooked people more
like.
than anything was just the complete dichotomy of those two essentially statements or releases. It clearly shows that there is some sort of debate going on internally there. And I think that probably spooked people more than anything else.
I think that's the problem.
Yeah.
I mean, the market hates uncertainty. A rising market hates uncertainty, I should say. And you might have disagreed with policies coming out of the president and all that, but, for the last few years, it's kind of, you knew sort of what you were going to get as far as the government is going to spend a lot of money, but now they're spending less. You don't like it, but it became sort of predictable. The Fed was buying bonds, and now they're doing it less. And all of a sudden, okay, we're going to raise rates. Everybody was kind of adjusting to that. And now maybe they're not because we're so worried about something else. And everybody just goes, right? At least from what I will call the headline algo type trading engines that, basically read the news and say sell, or buy. As soon as a Fed guy says we're going to raise rates, clearly that's bearish for stocks, and the algo guys just smack the crap out of everything. So, you didn't have that 100% kind of correlation type trading today. There were some stocks that were up, not many, but there was a couple. I don't know if Apple wasn't up, gosh knows where the market would have been, because I think that was a good chunk of $500 billion of market cap, kind of everything up to some degree. But that is the problem. So the more mixed signals we get out of the Fed, I think the less we're going to have. Volatility is going to come back. And for a while there, everybody was kind of getting the mantra of, okay, they're going to have to raise sometime in 2015 because we're growing. And it took time, but people got used to it. Now the confusion, as you said, is the dichotomy of opinions is now people are a little freaked out.
Well, speaking of dichotomy opinions, we are now joined by our resident bull, Uncle Mike Tusaw. Uncle Mike, welcome to the program. And what does this do to your diehard bullishness? I mean, we had the day like yesterday, which seemed to confirm all of your hopes and dreams about the marketplace, that there's nowhere to go but north, and then turn around today and it's a big slap in the face and a bucket of cold water. What does this do for your sunny, rosy outlook going forward, sir?
Well, it just goes to show that trading rules are much more important than market outlook, in my opinion. I have been bullish this whole way down, and I've obviously been wrong this whole way down, but from the standpoint of trading, I have taken off a ton of deltas back up at the 199, just maybe like the 197, 198 level on SPY. I forget where it was exactly, but I am on record on the show to having done that. But on here, I think that we have a buying opportunity, but I am either going to continue to stay at minimal delta exposure, which I am right now. Just to give you an idea of it, typically in my diagonal spread / where I'm buying my simulated index strategy, where I'm buying long calls and selling put spreads and or selling calls against it, I'm usually between about maybe a 70 and 90 delta, usually closer to 90 when you add up all the positions. And right now in that portfolio, and this is per contract obviously, right now in that strategy, I'm at probably about a 25 delta. And that 25 delta is at, it's on the 182, 187 put spread for next week, which I sold today on the dip. And so with that, we've done pretty well just basically selling these put spreads on dips and then making money on these for what some may consider as dead cat bounces. But with it, I'm not going to get back into the upside until we hit 202 on SPY, which will be new all-time highs. And to the downside, I'm not going to start adding deltas, or I'm going to keep playing at a very safe distance on this, because we've made money on these put spreads, and we're profitable since we've gotten out, but very minimal. I think we've made maybe 40 cents or something, but a 40-cent gain is better than a $6 loss, in my opinion. But to the downside, I still haven't figured out a number yet to the downside in terms of when I want to start adding significant deltas to this. On the SPY strategy, where we're long SPY the underlying and then long a put, I'm still in the 199 put, but what I've been doing to reduce deltas along those lines is I've been selling call spreads on the way down. And the reason for that is that I still want to capture some type of theta on it. I still want to have a little bit of skin in the game, not much, but usually that strategy, once again, it's between 70 and 90 deltas, usually closer to 90 per 100 shares. And right now that strategy is running at about 15 deltas. So that one, it's one of those things to where I'm thinking probably maybe another 10 or 20 points. I might roll down my 199 put, or wait, I'm sorry. Yeah, my 199 put, but it's because I do believe in doing stuff, but I don't know if I want to do any stuff just yet. So for the time being, we're still basically staying out, trying to capture a few little bits and pieces of time decay in the meantime. But I'm definitely still a bull. I definitely still believe in this market, but risk management, folks, has to come before market sentiment no matter what. And this is one area to where oftentimes when we're hedged as much as we are, we do trail the market, but we're hedged to high heaven. And so for clients that want to be a little more aggressive, we'll just adjust the portfolio accordingly to where we can keep up with the market or beat the market, assuming it is a bull market. But in cases like this, this is where we shine, and that this is a trading rule that has basically kept us out of a lot of this downturn that's happened over the course of the last couple of weeks.
Well, that's surprising, and not surprising, more just impressive that you the resident bull, the resident ray of sunshine here on the program, down to 25 deltas or fewer, and all of that pretty much in short put spreads. You're not even rocking the longer term calls anymore. I think that's saying something in and of itself. That's very interesting, I'd imagine.
Well, it's one I had to play by I'm keeping with a rule, and that I've been rolling in this rally for the last 50 years from what it feels like. I've just been rolling up calls as a means of protection. And then when we stayed below 199, I was at the 199 call for February. I'm like, well, I got to get out because vol had risen. And the concept behind it is that it didn't hurt me that badly on the way down because vol had risen, and that kind of helped prop the call value up somewhat, not a lot. And my thought behind it is that if we go back to 202, or if we make new all-time highs, and if I start going back to saying there's never been a better time to sell than right now or whatever, if I go back to doing that, vol will likely come down a lot, in my opinion, if we go back to that tomorrow. I mean, I think no one would disagree with that if we gain 10 points on or $10 on SPY tomorrow, or $9 on SPY tomorrow. But with that being said, it's just one of those things to where for the time being, I always like to look at the market can do one of three things. It's going to go up, go down, or stay the same. And if I'm not long premium, if it stays the same or goes down, I'm an obvious genius. But if it goes up, how bad is it going to hurt by missing out on the rally? And my opinion is that it won't hurt so badly because of the fact that volatility will likely come down. I'll make a little bit of money doing these put spreads in the time being. And so if I do get back in and miss those 3 points of rally that I would have missed on SPY or 4 points of rally from 198 to 202, I think that's a good risk reward ratio because it's not going to hurt so bad. And if we wait another 3 or 4 weeks, then I'll likely have sold enough put premium to make up for that anyway. So nonetheless, it's more important to play by the rules than go with your gut, if that makes any sense.
Yeah, this was it's hard almost to ascribe rules to a scenario like this because so many crazy things are going on at once. Of course, the equities are selling off. A lot of commodities taking on the chin as well today, including crude. We've been talking about crude a little bit on a lot of our other programs and sometimes on this program, but crude breaking well south of the 90 handle, I believe it hitting the 85 handle range or so today. So a lot of the energy services taking it on the chin quite a bit. GLD and gold doing a little bit of a dance today. Up one of the few things up. In fact, the Uncle Mike Tusaw package of gold and Apple, two of the only rays of green on my screen today. Gold up fractionally and Apple also up fractionally on the day. I think you can blame or thank a lot of the latter on Mr. Icahn once again coming out and talking up his position quite a bit, and it seems to have worked. You should send that guy a nice holiday bouquet, Uncle Mike, because he single-handedly kept your Apple from being down in the 2% range or so again today.
Oh yeah, I don't know if you saw that guy had a chance to watch the interview that he did today on CNBC. I know you don't watch that network, but nonetheless, I did when I found out he was on. I had to see that.
What is this network you're referring to? I'm not familiar with it.
Some alphabet soup network. Who knows? I don't know. But anyway, I thought it was a very good interview. He really stated a good case. I being the Apple bull that I am, he claimed that it's very undervalued right now, and that they have it valued, saying that Apple should be at $203 per share, as opposed to the 100. Yes, I said that right. $203 a share is what him and his people believe Apple should be. He's encouraged the CEO to do a share buyback of significant levels, and I can totally see where he's coming from on that. I mean, Apple has more cash than the U.S. government has debt, it seems. Well, maybe not that much, but I think there's definitely room for buyback there. I think that Icahn made a great case for it. I'm still very bullish on Apple, even with the competition with which they have, and the reason is because they're still the ones that are at the forefront. They may not have the best products. I personally own a Samsung Note, even though I am the biggest Apple bull in the stock in the world. I prefer that over the iPhones. But the way with which they market the company and that they take care of things, it's phenomenal. It's like, I personally hate McDonald's. However, I'm more of a Portillo's man. Portillo's, if you're ever in the Chicago area, if you're not from Chicago, if you want a great cheeseburger, Italian beef, you name it, Portillo's is the best chain ever to face God's green earth. But it's not about who makes the better sandwich. It's about who can sell it better, and that's McDonald's. Apple's the same way. Apple can sell their product better than any company in the history of the planet, it seems.
Yeah, it's ironic you mentioned those two, because they are, of course, across the street from each other downtown here in Chicago, and I've tried many times to convince my little guy not to go to the big rock and roll flagship McDonald's, but go across the street to Portillo's and get some nice, hot dogs and Italian beef and all that fun stuff, and he will have none of it. It's McDonald's or not for him. So clearly that marketing having worked in that scenario. All right, listeners, we're going to keep on rolling now. A lot to parse today. We're going to keep on rolling right on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Welcome to the Odd Block, listeners. That funky tune means it's time once again to talk about some weird, some wild, some downright bizarre options activity. You got a lot of names to talk about here, because looking here while we were talking before too about the market stuff and the old trading block and VIX, as you might imagine, lighting it up. Like I said, from a total volume perspective, the two big trades going up in VIX today too. I'm not sure if you caught these, Andrew, blasting out some OCC 20s to the tune of, looks like, about 86,000 contracts here, blasting out on the bid for 83 cents and then 81 cents, approximately 45,000 times the first time, about 42,000 the second time. So someone clearly giving up the ghost out there in this VIX upside. This is probably on the heels of all that crazy call activity we profiled in recent weeks in there, I believe to the tune of, was it 400,000 we talked about last week there, Andrew?
At least. It was a pretty big chunk.
So this guy taking off roughly 20% of it or so here today, saying, yeah, maybe I didn't need to put on all of those. It's like some size put spreads going up out here in the RUT as well, to the tune of 50,000 of the 1045, 1035 put spreads going up, paper selling. Like I said, 50,000 times. So some size action going up out here, and we could do a whole index odd block as well. But those are a little harder to parse because so much flow going up out there, but still just crazy paper going on today. We're going to focus on some smaller activity that caught our eye today on the old mothership, theoptionsinsider.com. Going to kick things off with some puts rolling down. Not a surprise, put activity going on a day like today. These are puts going up in AECOM Technology Corp, ticker symbol ACM, closing today $31.12, down about almost 3% on the day today. It's the name that does about 1,700 contracts a day, doing 12,000 today. So size paper for this name And what caught our eye was essentially what looks like to be a 5,000 lot roll, so a total of 10,000 contracts and some change here, was the Dees 32.5 30 put spread. Like I said, going up 5,000 times when we profiled it on the old site for 95 cents. Looks like paper rolling down from the 32.5 strike down to the 30 strike. 15,000 open on the 32 halves, only about 5,000 open on the 30. So this is indeed a roll. This guy's got, looks like a few more in the old chamber. He may want to be rolling here, and not surprising given the recent activity in ACM that he may want to roll down a little bit. This thing has been looking pretty much straight south ever since the middle of September. It was trading 37.5 not too long ago, a couple weeks ago. And now it's, like I said, trading down in the low 30 range. So this guy taking his money, taking some house money, and keeping it at work, but rolling down a little bit. Is that your take as well, Mr. Rock Lobster?
It is my take, as a matter of fact. This was kind of a theme today. It was also a theme in another program on the Option Insider Network of rolling puts. A lot of put rollers. Not so many like call rollers. Nobody was
surprise.
Happy enough to do that. But some put rolling, and Mike Tusaw is not the only person that does stuff. In order for those strategies to work out, if you buy puts when the market craps out, you have to take the money from them, especially if you're trying to hold on to the underlying at some point. You take those put dollars, and like I tell my clients, you take your hedge dollars and you go buy more stuff. You take your money from puts and you keep the put protection on, and then you buy some more underlying. And then, 3 years down the road, all of a sudden you have a lot more underlying than you started with. And that's kind of how you make money with these strategies. So and I just see that's what this customer is doing. Stock's kind of in the middle of the range. And they're going to take some money, some dollars off the table, and who knows what they're going to do with it. But they might just go spend it on, who knows what, Portillo's cheese dog, chili cheese dogs, or something like that. But that's what I see here, and this is kind of a theme here. I've seen a lot of rolling this week.
That's what Uncle Mike was just talking about, the debate of what to do with those 199 puts in SPY. He is certainly not alone in that conundrum. A lot of people facing those decisions, having been fortunate or savvy enough to have hedged ahead of these events. Now, what do you do with it? That's the other side of that coin. Another thing you can do with your puts is buy them ahead of time, and then, or sell them ahead of time, I should say, perhaps, and then close them out. That seems what our next player is doing over here. And Babcock and Wilcox Company, I know my favorite, ticker symbol BWC. Start my days every morning, a nice cup of hot Joe and some BWC quotes. That's how I start my morning. Closing today, $28.69, down about 2.6% on the day today, so pretty much in keeping with most of the other things we've seen. This is a name that does a surprising 200 contracts a day, so not a monster by any means. Doing nearly 2,000 today, so nearly 10x that. So comparatively, a pretty busy day here for good old Babcock and Wilcox. And what caught our eye was also some surprisingly long-term paper out here. These are the May 2015 25 puts that we're talking about. When we profiled them this morning, it was a 200 lot. But by the end of the day, pretty much all of that paper I talked about, 1,850 contracts, had gone up on this strike. It looks like the overall volume, the early volume, at least that 200 lot, of course, went up as one block, and the rest of the blocks kind of filtered in here. It looks like we got buyers here to the tune of buying stuff in the initial block, initial kind at least, for 70 cents. The others went up for different prices, went out 70 cents at $1. So somewhere in that range there, listeners. And it looks like open interest of about 4,300 contracts here. So this could be closing. Guy coming in. Looks like he may have blasted out some of these puts at a higher level before, and now taking the opportunity to take some of those profits, especially given the early stuff where he kind of chased the offer a little bit. That showed a surprising amount of aggressiveness for a very long-term put. He's got a lot of time to go on it. Clearly, he wanted to take them off and was in a bit of a rush to do so. With that, combined with the open interest, usually shows us that it's probably somebody coming in to close. Senior Rock Lobster, what's your take here on this guy racing the close apparently out here in BWC?
Yes, the market on these puts originally, I think this morning was like 45.70. You know, that is definitely an old school Chicago type.
I miss those days.
45.70, and they lifted the 70 offer for blocks of these on all electronically. And then the market quickly went 70 bid, $70 a dollar. So quite a jump in the value of these puts. So I thought I saw, I thought it looked like the guy probably got a nice sale off with the, if it was trading around $28, something like that. We had a little rally. There was kind of a gap rally in the name about last week sometime, traded close to 30. And now, the stock has pulled back and like, whoa, wait a minute, maybe we should cover some of these. You take the money we might have made, something along those lines. And that's where we find ourselves today. With, the vol jumping pretty good for what is supposed to be kind of a sleepy stock, pays, 40-cent dividend a year. And I think this recent volatility has taken everybody a little by surprise.
The guy's got an axe to grind when he's coming in. They're 45 at 70. He's like, I'll just take them all at 70. No middle ground, no negotiation, no dance. He's just, I gotta have them. Give me more. How many you got at 70? How are they now? That's always a guy who's got some motivation, shall we say, to get that trade done. Interesting stuff. Yeah,
definitely motivation.
Seems like maybe we're 2 for 2 here with guys who are playing with a little bit of house money. And this guy choosing to take it off, the other guy choosing to roll. 2 different ways you can play your put winners there, listener, on the old odd block. And all right, and we're talking here today, listeners, next up on the old odd block with Frontier Communications Corp, ticker symbol FTR, closing today $5.93, down about 4.5%. So about 2x the market overall today out here in FTR, and not a banner day for FTR. And like I said, we're looking once again at some long-term put action and some pretty sizable put action to boot. This is the name, to pull out a little Canadian there. This is the name that does about 2,500 contracts a day, doing about nearly 13,000 today. So size paper for FTR, and the lion's share of that, over 10,000 contracts, coming in some big trades on the Feb 6 puts to the tune of, when we profiled them this morning on the site, 6,837 Feb 6 puts going up for 55 cents. Paper buying, that went up in one block. As the day progressed, more blocks followed, like I said, to the tune of 10,127 total. Pretty much all paper buy-in. So this guy is just loading up. There is some open interest here, 6,400 contracts. So that early chunk could have been seen as perhaps closing, but the paper behind it certainly was not. Looks like this is some guy piling on here to the tune of saying, I want some more. I want to draw more lines here in the sand here on this 6 strike and protect myself. This has all the hallmarks of probably an underlying holder. Maybe he can't sell for tax reasons, so he's got to hold on to it here at this 6 strike, but also saying, hey, I'm very much concerned about continued prolonged downside in this name. Looking at the chart here over the past year out here in FTR, and this thing has seen some better days. It was trading up to right around over 7 not too long ago, back in late summer or so, and has come off that to the tune of down. We're in the 5-handle range now, and this guy clearly feeling that perhaps the worst is not behind them, because earlier this year, actually, even as early as January, this stock was in the 4-handle range, down to 4.5. So this guy clearly worried it may retrace, and for whatever reason, can't dump the underlying, so he's looking at some size puts. Is that your take as well, Mr. Rock Lobster?
That is my take. Surprisingly, that is my take.
We're copacetic today.
Just loading up. I was trying to think, is he buying, are these spec downside puts? I'm like, feeling like kind of a protective put here with this particular name, especially where, the stock is, if they were in it from like lower levels. it makes a little more sense. I mean, the stock was trading. I mean, it's not one that really moves a ton, but if they got into it at the 4 handle a couple years ago or something like that, easily buying the 6th level puts would make some sense at this point. So it's feeling like a little kind of protection. Volatility not cheap, kind of at the higher end of the 1 year range. So starting to see a lot of these vol charts, even in some of the ETFs and things like that, where we're seeing a really, really high vol. In a lot of places, that's a little surprising. Now, granted, VIX is definitely higher right now, one of the higher levels it's been for the year. But what I find surprising is all the very high volatility in a lot of these names that are more outside the earnings cycle. So we're starting to see just a little more of that kind of action. So somebody somewhere is buying some options, and they're not like Tucson buying calls when the vol is cheap. They're buying puts when the vol is not so cheap. So that's a different. That's kind of a different level to me.
Yeah, that's a different beast, and yeah, I definitely agree. Has all the hallmarks. A guy buying in the money puts for size, longer term. Definitely looks like a underlying holder to me. So we'll see. We'll see how that shakes out. Meanwhile, the show's going to shake out right on into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody. Like the man said, this is the Mail Block. Of course, it's Thursday. It means it's time for you guys to take your seat on the old All-Star panel with your questions, your comments, your insights, and perhaps even your own hilarity, whatever you want to send our way. We got a lot of them lined up today, so we're going to see how many we can get to. Coming out here first, question from listener Larry Sanders. Wasn't that a TV show? I think it was. He writes, "Hey crew, minus the Viceroy. Do you ever think we'll see a tradable skew product? Something like the CBOE Skew Index, but as a real product. Does that even make sense?" Interesting question, Larry. That we've talked before, just recently on Vol Views even, about our, shall we say, concerns or disappointment with what the CBOE has put out there from a skew index product perspective. It's really a once-a-day spreadsheet that they essentially put out. Mark mentioned on that show he has talked to them about that, and there might be some movement in making it more of an intraday updated type product. I've kind of given up on that argument with them because it didn't seem like it was going anywhere. Maybe there is finally some traction. That still wouldn't get to what you're talking about, though. That still wouldn't be a tradable, quote-unquote, product. That would just be this disseminated index value that they put out there. What you have right now, though, it does exist in the marketplace if you do want to trade skew. It is, of course, the 25, or as I like to call it, the 50 delta risk reversal. We've had this debate before. Of course, the 25 delta call and the 25 delta put, that's how you typically measure skew. That's how the CBOE does it with the skew index. So if you want to go out and trade pure skew, you can trade that 50 delta risk reversal right out there and do it yourself. So there is a quote-unquote tradable product. It's not disseminated like that. If they were going to make a product like this, they probably would just do that. They probably would just be quoting the value of that risk reversal, essentially. How you do it with an underline, that would be kind of interesting. A future on a risk reversal on the options, that would be interesting. That might be where the devil meets the details here. But it's an interesting idea. I just don't think we need it because we already have that 25 or 50 delta risk reversal, depending on your convention. Mr. Rock Lobster, we'll start with you. Where do you fall on our friend Mr. Sanders and his desire for a tradable skew product?
You just have to put together a position that trades the skew. There is the risk reversal. There are ratio put spreads. There's all kinds of stuff that you can do to mimic the skew that you want to buy or sell. So you have to decide. So I do a levered butterfly, not a levered butterfly, but an unbalanced fly, like a 1x3x2 or something like that, where you're really trying to get as much of that downside in as you can. Or you trade a regular ratio spread, or you trade that 25 delta risk reversal if you want, and you can tie underlying to it. So I got a position like that in the EWZ. So you can create the product yourself with the options. You just have to decide, on what at what do you want to do and at what level that you want to do it at, and you can create almost anything you want with the options, which of course is why we have, Option Pit and all this other optional education stuff, so you can learn how to do that.
Yes, indeed. So that's why they call them options, listeners. They're very, very, very mutable to whatever scenario you want to use them for. And so in this case, you can create your own tradable skew product in myriad different ways to do that. Great question there, Mr. Larry. All right, moving on. Another Larry. This is more of a comment. This comes from Dr. Larry. He's written in before. He's just writing in to thank us this time. He says, "Hi, Mark. Thanks for reading my bond question. I heard it today. Your discussion was very helpful. I've got some research to do now. Uncle Mike and Andrew's inputs were also very helpful." There you go, guys. You got some applause. Like you said, advice of what not to do is also helpful. I liked the idea of the far out of the money puts that are good bankruptcy protection. My bond portfolio is at Merrill, and I think you and I know more about options than my financial planner. Thank you very much for reading my question, Dr. Larry. Well, I'm sorry about that last part there, Larry. Maybe you should take your financial planner and point him to our advisor options show. There's 50-odd episodes of that show now, which will walk him through a lot of these types of scenarios that he might want to familiarize himself with. Or maybe between you and me, maybe you go find a better advisor who can do stuff like we talk about here on the show. You heard Uncle Mike today talking about how he's rolling and adjusting and doing all of these things. Do you think your guy at Merrill is doing that? Probably not. So whether you go with Uncle Mike or we go wherever, you deserve it to find a planner or an advisor who can do that stuff for you, because that's what you want. You want the advocate who can bring the most to the table at the end of the day. And if this guy is just essentially putting you in a Merrill spreadsheet and saying 60, 30, 10, okay, next, then you may want to look elsewhere. But there you go, Uncle Mike and Andrew. Your comments were appreciated as well. Uncle Mike, anything you want to say here to our friend Dr. Larry?
No, I think I'm happy they heard the show. I think it's a good thing, and I'm more than happy to discuss it further. If you'd like to give me a call, Dr. Larry.
Yeah, that was an epic question, if you guys remember, listeners. If you don't remember, let's tune into a few episodes back. It was an epic question about the bond portfolio and how to hedge it, and we had a variety of different suggestions and scenarios, and it fostered some interesting conversation on using options in conjunction with fixed income that we don't always talk about here on this show. So it was interesting grist for the mill, if nothing else. So interesting stuff. Glad to hear that it provided you some value there, Dr. Larry. Next up, we got a lot of people writing in about futures options these days. We'll start off the first one here from Tim. He writes, futures and options are both leveraged instruments. Well, correct, Tim. He goes on to write, so trading an option on a future is like using leverage to trade an already leveraged instrument. How is that legal? Didn't they crack down on something similar with options on levered ETFs? Aren't you essentially trading of a derivative at that point? Doesn't this call into question the entire futures options market? Well, I'm sure our friends at the CME will be shocked to hear this, Mr. Tim, that the entire marketplace has been called into question. What you're referring to with the levered ETFs, that is a good point. That was something that a lot of the brokers did a few years back when they saw a lot of people coming in and just loading up on options on what was already a levered instrument. And so they weren't really putting the proper margin requirements in place to reflect that additional level of risk. So that's what most of the brokers you'll work with, any of the mainstream ones, will do that now. They will require additional margin deposits and things like that if you're going to go out and blast out a bunch of puts on a levered ETF, for example. So that's kind of what you're talking about there. Not exactly the same thing as trading an option on a future, even though they are both instruments that utilize leverage. Maybe Mr. Rock Lobster, we'll start with you. Anything you want to... Oh, Tusa, actually. Let me start that over. Maybe Uncle Mike, will start with you. I know you like to play in both the ETF and the futures options realm on occasion. What do you have to say for our friend here who thinks the entire futures options market should be illegal?
Okay, well, I'm sure he doesn't think it should be illegal, but I think it's just a matter of understanding. And so the way with which I like to explain this is that you view it as the actual size of the futures contract. What futures offer is that securities do not, is a way with which you can have a lot of leverage. So, for example, the point with which you need to make, that I want to make, is that you need to have an understanding of the size of the actual contract. So, for example, SPY, if you were to buy 500 shares of SPY in one account and go long one S&P E-mini contract in the other account, you'll get the same results for better or for worse. The difference is that with the SPY, your maintenance requirement is going to be 50% of the actual value of the contract, which will be roughly $45,000. That's how much you'll have, and it's approximately $90,000 to $95,000 is what 500 shares of SPY would run you these days. Now, on the other side, for the S&P E-mini, that's the size of a one lot of an S&P E-mini, meaning let's say that you went long and then theoretically the market went to zero, you would lose that much money. However, with the S&P E-mini, you don't have to have 50% in the account. You only have to have, I believe it's around 10% right now. I haven't done any E-mini futures contracts in a while, so I don't know exactly what the requirement is right now, but that's about what you have to have in there. The gains and losses are going to be the exact same. Now, you could say, well, if you don't want that much leverage, they won't stop you from having $90,000 in your account and doing a one lot. I guarantee you no broker would stop you from doing that and say, hey, you got too much money in here, you got to take some out. It's not going to happen. So with that being said, you might say, well, what's the advantage or disadvantage of either one? Let's say you wanted to have no leverage, but you want to be able to trade it at 2 a.m, then put the 90 grand in a futures account and do the S&P E-mini. There's no leverage, and it's the same thing as doing 500 shares of SPY. Now, in terms of the options, it's the similar concept. A one lot on the S&P E-mini is the exact same thing as, I shouldn't say the exact same thing, but it's pretty darn close to a 5 lot on SPY. I know there's advantages and disadvantages to each, but I think what the major issue that you need to look at here is just have an understanding of what the actual size of the contract is. Yes, it is a derivative on a derivative, but if you buy a call option, if you buy one call option on one call option on the E-mini and 5 call options on SPY, then you still have the limited risk that a call option gives you, or a put for that matter. You just have to have an understanding of what the sizes are and what's at stake.
Anything to add there, Mr. Rock Lobster, for our friend who believes all futures options traders should go straight to jail? Do not pass go.
They are evil. Well, let's just say I'll do the obvious one. Did the CME blow out in the 2008 crash? I'll answer that. No. Okay. Did the CBOE blow out in the 2008 crash? No. All right. Who blew out? Who blew out? Almost every bank on Wall Street. So it's not the right. And these are the places that are clearing, right, or organizing and managing the clearing function, right? Who had, who had some substantial risk, right? Because the CME owns the clearing for those futures contracts. So as long as you have rules in place and you follow the margin rules, they're fine. It's when you decide to ignore the margin rules because things aren't going great, where you have a problem on almost any trade you have, whether it's a future option, whether it's an equity, whether you sell puts, anything along those levels. So, people don't think anything about buying a house, putting 10% down, right? So it's more important to have rules that you can live with. Actually, what Mike said at the beginning of the show on how you approach whatever you're going to invest in. And it has to be something you can live with, whether it's a futures options contract or anything else. And if you manage things with rules and are diligent, you actually have a shot at succeeding. And if you kind of take those rules and you chuck them into the wastebasket, just because things might not be going well, that's when you run into trouble. So I would just suggest, instead of going out and trying to outlaw all the contracts, spend a little more time trying to develop, risk management principles that you can live with. And then when you're in the position, you actually use the leverage when it's advantageous for you, because then you'll have the room to use it. And that's my thoughts there.
Well said, sir. I think we got time for one more quick one here. This one comes in from Jim. He writes, "Dear editor, like your programs, but have been wondering why the recordings are not made available the same day. Listening to something a day late with today's actual market results dramatically reduces your program's relevance." Well, interesting comment, Jim. We've debated this internally before. And the reason the shows come out the next day is because, as you might imagine, on a day like today, people have a lot of things going on, a lot of businesses they actually have to tend to. So getting the whole panel together, first off, takes some time, and we have to clear everybody's schedules, everything like that. So getting something that we can turn around live intraday like that would be very difficult. A day like today clearly is a good example of why that's not the case. But we do endeavor to put it out very early, so you can get it the next morning. A lot of our people like to listen to it when they're commuting, and that's typically the use case for a lot of the listeners of a show like this. They're coming into work on the train or on the bus or in the car or whatever, and so they're listening on that. And so we do endeavor to get it out there pretty quick, and it is stuff for that the previous day that you can use in that session. We don't expect for you to take the unusual activity we're talking about right now and instantly trade it. But that said, we have toyed with ideas to put some stuff out live and maybe create some sort of live streaming. So those of you who want to come in and listen live and maybe interact with the hosts live, we are doing that with one of our most recent additions to the network. It's a live show and it's kind of fun, but as we're experiencing with that, it's a whole heck of a lot of trouble from a technological perspective. So we're still working to get all that sorted out. And maybe if we do, then maybe we can put out some live versions, allow you guys to maybe join us on the show here a little bit. But in the meantime, there will always be a well-edited, professionally produced product that comes out early the next day, so you guys can get a hold of that and listen to it in your on-demand leisure. And if you want real-time stuff, of course, and stuff that same day, of course, we have the Options News Rundown. We have our other daily program we just added to the network, and there's more coming down the road. So we certainly have offerings for you there. Great questions, everybody. Keep them coming. I wish we could spend a whole day doing questions, but we got to keep rolling right on into Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. This is indeed the portion of the show where we tell you what we're watching. I think a lot of us are pretty much just watching the free fall that we saw today. If that continues, we did close at or near the lows in most of the major indices, so that was a little bit disconcerting for a lot of people. If this schism continues to surface in the Fed, if that will continue to weigh on the markets, if indeed Hong Kong erupts into something reminiscent of what we saw in Tiananmen a few years back, then that will certainly continue to weigh on the markets. Or if it's all rainbows and lollipops like it was yesterday, in which case we're going to erase all this in a few hours tomorrow. I think that's where pretty much all of us are watching. Uncle Mac, we'll start with you. I know you're watching very heavily that 1290, that 1990 level out there in the S&P, so you can adjust your puts.
Yeah, for the most part, what I'm looking at this point is that for SPY, I'm in the 192, 187 put spread. So the 1920 level is around there is a pretty key level for me at SPX. I'm still going to hold on to the put spread. I'm going to let it go in the money a little bit. And the only reason that I'm going to allow it to be a little bit looser is because of the fact that I don't have any call exposure. So I can be a little bit more risky with this because of the fact that I have a lot less deltas on the table with this one. So watching that pretty much laser focused tomorrow. I think that if we can get a little bit of a rally tomorrow and some of the volatility comes off, there's going to be a whole lot of grinning going on in this office, mostly by me.
Well, you're prone to grinning regardless. I think your orthodontist says you grin even when you're in there. So you're a different beast when it comes to that.
That's true.
Uncle Mike. All right. And now the other side of that coin, the diehard cynic and skeptic. Mr. Rock Lobster, what are you watching for the rest of this week into the weekend?
I am watching. We had kind of the curious situation today where cash VIX closed. My last look at the print on the futures closed above every future price, almost every future price, all but the April. And we haven't seen that in a while, where, that's definitely, to me, that's a little bit more movement creeping into the market. We've got the October future now over the November settlement, November future price again. All that stuff to me just says more realized volatility coming ahead. We've actually got the October priced over the D's future. No surprise with December. It always trades a little cheaper because of Christmas and that lovely holiday, which is hard to believe. That's only 3 future cycles away. But that looks like some more volatility ahead, and that's what I'm watching.
Got to go all the way out to April to trump the VIX Cash. That's saying something in and of itself. And you're right, that perhaps shows there is a little bit more vol going to be creeping in the days ahead. So a lot to watch tomorrow. Let me check in with each of my cohorts here on the old All-Star panel. See what they have cooking that may interest you. Starting off with you, Mr. Lobster. In addition to scraping all those barnacles, what else is coming down the pike over there in the land the pit?
Look for a portfolio management seminar. We just had our very successful vol seminar, like the 1-2 punch. Look for a portfolio management seminar similar to basically adjusting and doing stuff with index positions. That should be coming in this, between right around the November, December timeframe. And our boot camp will be starting up again in December as well. So, a lot of, if you want to, again, we're an education firm trying to do this stuff for yourself, we will be available for that.
And stay tuned for his weekend webinars, How to Scrape Barnacles, because I'm hearing that's where the next big market is there, Andrew. I think you've got it cornered.
They're hugely popular.
All right. A man of many talents. And speaking of that, we're, of course, also joined by Uncle Mike Tusaw. What's cooking in the land of RCM, Uncle Mike? What can listeners look forward to?
Well, give me a call, folks. We got some crazy markets going right now, and I'll tell you what I'm doing in detail, and I'll tell you how it could possibly help you. 312-212-3531 or mtusaw@rcmam.com.
All right, listeners, and on behalf of Uncle Mike and the Rock Lobster, and indeed the Viceroy who couldn't make it, and if you haven't done so, listeners, A, what are you doing? But B, surf on over to optionsexpress.com. Check out all the cool stuff they have over there. All the education stuff that Alex is always going on about is all there pre-login, all completely free, so you can check it out, kick the tires for yourself, and see if you like it. And if you do like it, you sign up for an account or you do a paper trading account, and you can get access to all those cool tools we're always talking about, like the trading patterns that we use for the guessing game, and indeed, like Alex's baby, the Idea Hub. A lot of cool stuff over there. Check it out, optionsexpress.com. And tell them the Option Block sent you. They'll love to hear it. On behalf of Uncle Mike, indeed, and the Rock Lobster and the Viceroy, and of course myself, I want to thank all of you for downloading and streaming and subscribing and for sending in such great questions. Couldn't get to all of them, but we'll get to more next week. And we'll see you next time right here on the Option Block.
The Option Block was brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.